Ever wondered about the pros and cons of fundamental analysis and technical analysis? Well, you're in the right place. Today, we'll be unpacking these two key approaches used by investors and traders worldwide. Starting with fundamental analysis, we'll delve into how it helps in evaluating a company's intrinsic value and long-term prospects. Then we'll explore technical analysis, which uses price and volume data to identify short-term market trends. So, without further ado, we dive into the world of fundamental analysis. Fundamental analysis offers several benefits for investors. It's akin to taking an X-ray of a company's financial health, peeling back the layers to understand the underlying business fundamentals. This approach provides a long-term perspective, allowing investors to look past the daily market fluctuations and focus on the company's prospects and intrinsic value. One of the key advantages of fundamental analysis is its focus on intrinsic value. By analyzing factors like earnings, cash flow, and assets, investors can estimate what a company's stock is truly worth. This valuation provides a benchmark, a kind of financial yardstick, if you will, to determine whether a stock is undervalued, overvalued, or fairly priced. It's like shopping for a bargain in the stock market, where you're looking for quality stocks that are selling for less than their estimated worth. In addition to providing a valuation benchmark, fundamental analysis helps investors identify investment quality. It's not just about finding any stock, it's about finding high-quality companies. These are the companies with strong competitive advantages, sustainable business models, and solid growth prospects. Investing in such fundamentally sound companies can lead to consistent returns over the long term. So think of fundamental analysis as a tool for weeding out the weaklings and identifying the champions in the stock market. In essence, fundamental analysis is a proactive approach to investing. It's about doing your homework, understanding the business, and making informed decisions. It's about identifying opportunities for long-term growth and investing in companies that have the potential to deliver consistent returns. It's a strategy that requires patience and a keen eye for detail, but it's one that can yield significant rewards for those who master it. However, it's not all sunshine and roses. Let's explore some of the drawbacks of fundamental analysis. Despite its advantages, fundamental analysis has its limitations. One of the main drawbacks of fundamental analysis is its limited short-term insights. While it's excellent for long-term investments, it often overlooks the short-term price fluctuations driven by investor sentiment, market speculation, or macroeconomic factors. This means that if you're interested in short-term trading or timing the market, fundamental analysis may not always provide the timely insights you need. Another challenge with fundamental analysis is its complexity and subjectivity. To accurately analyze a company's financial health, you need a deep understanding of accounting principles, industry trends, and company-specific factors. Even with this knowledge, interpreting the information can be subjective. Two investors might look at the same data and come to different conclusions, influenced by their individual biases. This subjectivity can lead to differing opinions and debates among investors, making it difficult to reach a consensus on a company's true value. Lastly, fundamental analysis relies heavily on the availability and accuracy of financial data. Gathering reliable data can be a challenging task, especially for companies in emerging markets or industries with limited transparency. It's not uncommon to encounter inaccurate or incomplete data, which can lead to flawed analyses and, consequently, ill-informed investment decisions. In addition, financial reports and statements provided by companies are often prepared with the aim of presenting the company in the best light possible. Therefore, they might not always reflect the true state of a company's financial health. This means that, as an investor, you need to be cautious and discerning when interpreting these documents. In conclusion, while fundamental analysis is a powerful tool for understanding a company's intrinsic value and long-term prospects, it's not without its drawbacks. Its limited short-term insights, complexity and subjectivity, and dependency on data availability and accuracy can pose challenges for investors. Now that we've examined the pros and cons of fundamental analysis, let's move on to technical analysis. Technical analysis, like fundamental analysis, has its own set of benefits. One of its major advantages is its focus on short-term trends. Unlike fundamental analysis, which is more about the long game, technical analysis zeroes in on the here and now. It's all about analyzing the price and volume data of a security to identify short-term trends, patterns, and trading signals. This approach is particularly useful for day traders or swing traders who aim to capitalize on quick market movements and profit from short-term market opportunities. Another significant benefit of technical analysis lies in its objectivity. Technical indicators such as moving averages, relative strength index, and Bollinger Bands, to name a few, provide objective signals for trading decisions. These indicators and chart patterns give traders clear entry and exit points, reducing the emotional biases that can often cloud judgment. By basing decisions on quantitative data, traders can make more disciplined and potentially profitable moves. But perhaps one of the most appealing aspects of technical analysis is its emphasis on timing and precision. Timing, as they say, is everything in the world of trading, and technical analysis allows traders to time their trades more precisely. It helps traders identify exact entry and exit points based on price levels, support and resistance levels, and trend reversals. This precision can significantly improve trading performance and risk management. It allows traders to maximize their profits and minimize their losses, enabling a more efficient and effective trading strategy. So, to sum it up, technical analysis offers a focus on short-term trends, objective trading signals, and precise timing. These advantages make it a valuable tool for traders, particularly those who are active in the market on a daily basis. However, it's also important to remember that no approach is perfect. But just like fundamental analysis, technical analysis also has its drawbacks. While technical analysis can be a powerful tool, it's not without its pitfalls. Firstly, let's talk about the lack of fundamental context. Technical analysis primarily focuses on price and volume data, often overlooking the company's underlying fundamentals. What does this mean? Well, it could lead to trading decisions that are disconnected from the intrinsic value of a stock or the broader market environment. You might be tracking a bullish trend on a stock chart, but if the company's financial health is deteriorating, that uptrend may not last. So, while technical analysis can present you with an immediate picture of market sentiment, it might miss the bigger picture of a company's overall health. Moving on, we encounter another potential pitfall: subjective interpretations. Reading chart patterns and technical indicators isn't always black and white. Traders may interpret the same signals differently, leading to differing opinions and inconsistent trading strategies among market participants. One trader might see a head and shoulders pattern as a bearish reversal signal, while another might interpret it as a continuation of the current trend. This subjectivity can muddy the waters and make it difficult to establish a clear, objective trading strategy. Lastly, let's touch on the limited predictive power of technical analysis. While it can help identify short-term trends and trading opportunities, its predictive power for longer-term price movements is somewhat limited. Remember, past performance is not indicative of future results. Just because a stock's price has increased steadily over the past 3 months doesn't necessarily mean it will continue to do so. Market conditions change and trends can reverse without warning. In summary, while technical analysis provides valuable insights into market trends and patterns, it's important to be aware of its limitations. A balanced approach, combining both fundamental and technical analysis, can provide a more rounded view of a company's prospects and potential investment opportunities. With that, we've covered the main pros and cons of both fundamental and technical analysis. So now you know the pros and cons of both fundamental and technical analysis. Let's do a quick recap. Fundamental analysis, with its intrinsic value estimation and long-term perspective, can help identify high-quality companies for long-term investment. However, its complexity, subjectivity, and dependency on data availability and accuracy can make it challenging for short-term trading and market timing. On the other hand, technical analysis, with its focus on short-term trends and objective signals, can help traders to precisely time their trades and profit from short-term market opportunities. Yet, Its lack of fundamental context and subjective interpretations can lead to trading decisions that are disconnected from a stock's intrinsic value. Plus, it may not be as predictive for longer-term price movements. Both approaches have their strengths and weaknesses, and neither is superior in all situations. The choice between fundamental and technical analysis often depends on your investment goals, time horizon, and personal preferences. Some investors may prefer the depth and detail of fundamental analysis, while others may favor the immediacy and precision of technical analysis. So remember, the best approach often combines both fundamental and technical analysis, depending on your investment goals and time horizon. Thank you for tuning in.